To say that the past couple of months have been difficult for my portfolio would be an understatement. In fact, today I'm going to talk about 5 stocks in which I've invested nearly 50% of my real life portfolio. And on average, these stocks are down 31% so far this year. Obviously, that is not a fun ride to be on. So, what are the stocks? Well, the roster that I'm talking about is Mercado Libre, C Limited, Nvidia, Axon, and Transmedics. And as I said, right now, it's roughly, these 5 are 50% of my real life holding. So what's going on with these stocks and what am I going to do moving forward? That's what we're going to talk about today. My name is Brian Stoffel, and as of the time of this recording, of course, I own all 5 of these stocks. Now, one thing that I want to be clear is, why is there so much underperformance? Well, the main reason for that is that I have not been heavily invested in the AI infrastructure level, especially chips, with the exception, of course, of Nvidia. Look, right now, I think that the hype surrounding the AI infrastructure build-out is completely valid. And there are companies that, given that they are essentially selling water in the middle of a desert, and by that I mean memory chips, CPUs, things like that, in an area where everybody wants them, they deserve to have the run-ups that they've gotten. And I have nothing against that type of investing. It's just not the type of investing that I normally do. And the thing is that at some point, this trade is going to get crowded. Supply and demand may come into equilibrium. And when that time happens, it might be tough to hold those stocks. I love when a company has some type of structural advantage that can keep it going. It has lots of new ways of creating new revenue streams. And in many of these cases, you will notice that there is short-term margin pressure being applied right now. And that's by design. It's to widen the moat around these companies. So what are the high conviction 5? As I said, Mercado Libre, right now, they're taking margin hits to build a logistics fortress. C Limited, same thing, only in a more difficult macro environment. Nvidia, not so much fitting that theme, but I think it's the safest toll road in all of AI. Axon has 5 layers with a widening moat around it, and Transmedics is an FDA-cleared monopoly. So let's dive into each one of these. Let's start with Mercado Libre, because the thing to know right now is the reason that the stock is down so much is because the company has been aggressively reinvesting in shipping and fulfillment. That's what the market fears, because that pulls down margins. And they also think that that is a sign that competition is encroaching. It is true that competition is encroaching, and it might be true that that's what necessitates this. But it doesn't erase the fact that it creates a powerful flywheel where this heavy fulfillment spend leads to a widening moat in Latin America because no one else can ship packages to someone's front door as quickly as Mercado Libre can. That accelerates gross merchandise volume. This is what I'm talking about. This is the company's gross merchandise volume over the years. And what I want to show you is that over the last 2 years, that gross merchandise volume has been accelerating. That's on an annual view. If we look at this on a quarterly view, it's even more impressive, where gross merchandise volume growth went from 8% and has accelerated all the way up to 42%. And that is unmatched convenience. That is the real thing that Mercado Libre is building. Now, the critical metric to watch with Mercado Libre is actually not the margin pressure because of logistics and fulfillment. It is their credit portfolio, which is growing very fast. Now, so far, they've done a great job of that, but keep your eye on loans 15 and 90 days past due. If that starts to tick up, that would be a warning sign. But let me give you an idea of just how cheap this stock is by doing a reverse discounted cash flow analysis. Now, Mercado Libre is an interesting beast because it does make loans, so its free cash flow can be inflated. Let's assume that at a steady state, it has roughly 20% free cash flow margins. If we assume that, then it would have $6.36 billion in free cash flow today. We're optimizing it, and we're actually optimizing it down. If we give it a 3% terminal growth rate and a 10% discount rate, well, the company does not need that much growth to hit what its stock is valued at today. In fact, we would need to pull this terminal growth rate all the way down to about 1%. and say that revenue only needs to grow about 3 or 4%. Now think about what I'm saying here. If Mercado Libre can hit 20% free cash flow margins, which I think is very possible, and if Mercado Libre can just have a terminal growth rate of just 1%, which is very low, then today's stock price assumes that it's only going to grow 3% per year moving forward. How, what do we think about that? Could it do that? And the answer is yes, it should be able to do that very easily. I mean, all we have to do is check out where revenues have been recently. I mean, this is just quarter by quarter over the last couple of years. If we look at this on an annual basis, what we'll see is that not only can the company grow at that, it's been growing above 30% ever since 2019. Yes, since 2019. And that revenue growth, as you can see, is actually accelerating. So I think those are very, very low expectations. I mean, even the conservative estimates that I see on Wall Street say that it is well above that 3% threshold. So this, to me, is a screaming buy at these prices. All right, so that's Mercado Libre. Next, let's head on over to Sea Limited. Now, it's roughly the same playbook, the e-commerce, the payment arm. They also have a gaming arm called Garena, but it is in a harder macro environment. And that's for a couple of reasons. One, Southeast Asia, where they're primarily operating, although they do have some operations in Brazil, is really affected by what's going on in the Middle East. Asia gets a lot of its oil from Iran, and because of that, that puts a lot of pressure on those economies. Also, there's competition from TikTok Shop. TikTok Shop doesn't have the logistics that Shopee, which is Sea Limited's e-commerce arm, is building out, but it is very popular. And finally, like Mercado Libre, right now, Sea Limited and Shopee in particular is being punished for its spend on logistics and fulfillment. That said, much like Mercado Libre, gross merchandise volume is accelerating. Valuation is conservative. I'll show you both of those things in just a second. But as with Mercado Libre, Sea Limited's lending arms, Money, M-O-N-E-E, is really growing its credit portfolio quickly. And like Mercado Libre, the key thing to watch is actually not the margins because of the logistics spend. It is the loans past 15 and 90 days due. If those start to tick up, that is a warning sign, a legitimate one. So what I pulled up here is Sea Limited's gross merchandise volume. And what I want to show you is after it really boomed during the pandemic, we saw the growth rates for gross merchandise volume come down to just 7%. But as you can see, the company has shown an ability to continue growing gross merchandise volume, growing at about 30%. And if we look at this on a quarterly basis, we can see that some of those investments that the company has been making in shipping and logistics are really paying off. Ever since March of 2025, those GMV growth rates have reaccelerated from about 21% all the way up to 30%. And if we look at the valuation, we see a lot of the same thing. Now, because Sea Limited is operating where they don't have nearly as much of a head lead as Mercado Libre does, I'm not going to give them 20% fully optimized free cash flow margins. I'm just going to give them 15% to be a little bit more conservative. And if I did that, then the company would have roughly $3.8 billion in free cash flow. So if we optimize that and we ask ourselves, well, how fast does Sea Limited need to grow? Even with an extremely conservative 1% terminal growth rate, we're talking about a company that only needs to grow 5% per year over the next 10 years and get those 15% free cash flow margins in order to justify today's price. I mean, to me, this is a screaming buy. If we go ahead and we pull up the company's their revenue growth rate over the last couple of years, I think you'll get an idea of what I'm talking about. So what we can see right here is that those growth rates, they did come down right after the post-pandemic boom ended, but they have been reaccelerating very nicely from 5% in 2023 all the way up to 46%. And if we look at what analysts are expecting over the coming quarters, they expect it to slow. But first of all, analysts have been underestimating what the company can do for quite some time. They've been surprising to the upside. And even so, even within a year or so, we're talking about a company that would still be growing at 21%. And we're saying it only needs a growth rate of just about 5% per year over the next 10 years. So that is Sea Limited. Next is Nvidia. Now, I will admit, it is not the most explosive trade or AI bet anymore. It's gotten a bunch of gains, but I believe that now it's one of the safest toll roads if you want to invest in the AI infrastructure. We all know about the GPU core and how it moved from graphics, gaming, and cryptocurrency to dominate AI and be the driving engine behind what's happening in the world around us today. But what's important to note is that it is making meaningful inroads in CPUs, and really building the full stack for the next leap that's going to happen in AI compute with the Rubin generation. And they have said that they're going to come out with a new generation every single year. Now, the noise right now, I make sense. Customers are racing to build their alternatives. We see that with Google, we see it with Amazon, and it's a way to dodge the Nvidia tax. But the demand is so heavy and the lead is so significant for Nvidia that I think it still trades at a very reasonable assumption on a forward basis. Again, if we do a reverse DCF on this, here's the thing. When I optimize the free cash flow margins, I'm going to bring them down. They have reached as high as 50%, and I'm going to bring them all the way down to 35% because I will give some credence to the competition and people wanting to avoid that Nvidia tax. So I'm going to bring it all the way down to 35%. But even if we do that, we're talking about $89 billion in free cash flow that the company would have. Now, with that, what we're saying is the company needs to be able to grow their revenue by about 22% per year. We could actually pull that down even more because the company will be buying back shares with the extra cash that it generates, maybe 21% per year over the next 10 years. Now, that is a high hurdle. However, look at where growth has been. While it did dip in 2023, and it is a cyclical industry, we're talking about a company that is currently growing at about 71% per year. Over the next couple of years, it is expected to grow 82%, followed by 41%, and then down to our target of about 21%. Now, if it falls all that way, you might be saying, well, Brian, you got to do this for 10 years. If by year 3 you've fallen that far, that's a problem. And that's true, but there's two things to remember. First, the company regularly beats these estimates, so I would not be surprised to see revenue growth come in 85 to 90%, and over here come in around 50%, and over here come in at around 25 to 30%. And if it does that, then the growth rate that they need from year 4 to year 10 is actually much lower than this. And remember, I also had relatively conservative free cash flow margins for Nvidia as well. So I think that this is a very fair price to pay to still participate in the AI trade if you're a little bit reticent about that because you're not sure about the moats in this industry. So that is Nvidia. Next, let's talk about Axon Enterprise, a company that I think is one of the most misunderstood, both in terms of the business and the valuation. The company started by focusing on taser stun guns. That's what it was for most of its corporate life. And then around 2010, they started making inroads into body cameras. Then they took the film from those body cameras and started creating their first SaaS offering, which was evidence.com. That was the linchpin that really locked everyone in. Once a police department started using evidence.com to store all their body camera footage, to make it searchable, to make it shareable, then the switching costs just went through the roof. And they've used that data lead to create things like Dispatch and 911, but also a lot of agentic AI tools like Draft One, which can draft a first report of a police report for an officer, or real-time translation services. And oh, by the way, they're getting into robotics with Axon Air. That's where police forces have their own drone capability, and Dedrone, which is where police forces and first responders can take down drones that are places where they shouldn't be. And the areas for expansion are still huge here. The company is making big inroads abroad, but also with federal agencies and with enterprises. So the hardware feeds the data feeds the software, the AI feeds the efficiency, and the customers are locked in for life. And as I said, I think this is one of the most misunderstood value propositions that are out there. Look, when this company just sold tasers, they had free cash flow margins that were between 20 and 25%. Once they've got that fully optimized software layer sitting on top of it, I don't think it's unreasonable to believe that they can have 30% free cash flow margins. And because of these super wide, non-cyclical margins, I think it's totally reasonable to give a 3% terminal growth rate. Now, if we gave them that 30% free cash flow margin, then that would give the company roughly $900 million in trailing free cash flow. So if they have that, then how fast does revenue need to grow over the next 10 years? And the answer is a lot slower than you might think. It's actually closer to around 15.5% per year. So let's think about this. They need to grow 15.5% per year over the next 10 years to justify today's stock price. Let's add on another 2.5% to that because management has said that that's roughly the dilution rate that they see for the company and its shareholders moving forward. So that ups it to about 18% revenue growth that's needed per year over the next 10 years. Well, this right here shows you where the revenue growth has been over the last 10. And notice that in the last 10 years, not only has it never been below 20%, but it has been accelerating through this period. And management has gone on record to say that they believe that they will have roughly 30% growth over the next 3 years. And I believe that there are lots of different levers that they can continue pulling. This is a company that has a demonstrated history of optionality. So I think that shares are actually very reasonable today, even though it might look expensive if you're just looking at its multiples. The final company I want to talk about is Transmedics, which holds an FDA-cleared monopoly on warm perfusion organ transport. It's cleared for the heart, cleared for the lungs, cleared for the liver. And so the optionality that really comes into play here is there are clinical trials that are being conducted to get FDA clearance for the kidney, which is a huge market, and next generation machines rolling out for lungs and heart, which is important because the liver is doing all of the heavy lifting right now in terms of revenue. It's also worth pointing out that there are lots of people that legitimately, and I think this is fair, are worried that alternatives could undercut Transmedics on price because what Transmedics offers is expensive. They have their own aviation unit to run these organs across the country. However, it is worth pointing out that the undeniable fact is over the past couple of years, the organ market writ large in the United States has been growing, and Transmedics solely is responsible for most of that growth. Over the last 2 years, their market share in the organs that they operate in the United States expanded from 20 to 26% roughly in just 1 year. And that is a huge sign, an undeniable sign that I think that the company is winning despite these very legitimate concerns. Now, as with all the others, we will give this company a reverse DCF. Now, when we do this, we're not going to give it the 30 to 35% free cash flow margins that you might see on medtech like Intuitive Surgical. The big reason for that is the fact that this aviation unit is much lower margin. It's moat widening, but it is lower margin. So we're just going to give them a 20% fully optimized free cash flow margin. So if we did that, then that would be roughly $130 million in trailing free cash flow. And if they did that, then they would need to grow their revenue by roughly, let's see here, 10% per year, 8% per year, about 8% per year over the next 10 years. Here's where that revenue growth has been. Here's a look at where analysts think they're going. And even beyond that, which all of these numbers are well above that 8%. I know it has to carry out for the full 10 years. But the thing that I would point out is the fact that Transmedics has shown that they believe that they can grow very fast. Right now, they're sitting at around 5,000 transplants last year. They believe that they could reach 20,000 transplants by the end of 2030. That would be a 31% growth rate roughly off of this base. Now, the amount of money that they get per organ might come down during that time frame, but even if it does, that is still much more than the 8% that is assumed in this. Now, here's the thing. If you love analysis like this, I think my program, Stock Investing Mentor, is just for you. There are 3 parts to it. First, you get real-time access to my portfolio and any changes that I make in it. Every 5 weeks, I give you my favorite 5, my top 5 stocks that I would be investing in just like this if I were a new investor. And there's ongoing coverage with full anti-fragility scores of all the stocks. And there is 1 hour every week of live training that is recorded if you can't make it, and 24/7 access to a live online investing community. Now, if that interests you, you can get 10% off an annual membership by clicking that top link in the show notes below. Look, the bottom line when it comes to these 5 stocks is that they are unloved right now. And I get it. The AI trade works. It's valuable. I see the data centers going up around me. This is not a mirage. However, it is ignoring the fact that if you have a long-term time horizon, there are wide moat stocks that are available that I believe might not do as well over the next couple of months, but over the next couple of years would do very well. Let me know what you think of that conclusion in the comments section below. And don't forget to hit subscribe to keep up to date the next time I make a video just like this. Until then, Brian